Professor Andreas Bielig is an expert in international economics and financial regulation at the SGH Warsaw School of Economics. His research examines regulatory approaches to financial innovation across different economic systems. Dr. Yuri Biondi is a senior tenured research fellow at the French National Center for Scientific Research, focusing on accounting, economics, and law. His work explores financial and economic implications of digital currencies from a systemic perspective. Professor Seraina Grünewald specializes in financial market law and regulation at the University of St. Gallen. Her research focuses on the regulatory challenges of digital currencies and their integration into existing legal frameworks. Professor Christos Hadjiemmanuil specializes in banking law, financial regulation, and central banking at the University of Piraeus and the London School of Economics. His work examines the legal challenges in balancing innovation with regulatory oversight in digital currencies. Professor Bart Joosen is an authority on prudential supervision law and financial markets regulation at the University of Leiden and the European Banking Institute. His work examines the regulatory challenges of integrating digital currencies into the existing prudential framework. Professor Reyes Palá Laguna is an expert in financial market regulation and corporate governance at the University of Zaragoza. Her research focuses on the Spanish and European regulatory approaches to digital financial innovation.
To all of you, it is a great pleasure to be chairing this panel with so many distinguished speakers. We will be addressing the balancing of innovation and oversight, addressing questions such as how much and what kind of regulation we may need, whether regulation necessarily creates a trade-off with innovation, and what should be the footprint of central banks in the ecosystem of digital money and payments. Is, in particular, CBDC necessary to encourage innovation, or does it actually hinder innovation? The panel will bring together various perspectives. It's wonderful to have you all here. Unfortunately, our dear colleague and friend Bart Joosen cannot be with us today. He will be dearly missed. Now, my job as a chair is rather simple today. I just have to have a firm eye on the clock. And without further ado, I'll pass the word to Yuri. Thank you.
Right, this is working, is it? Even too strong. So thank you very much. Thanks to the organizer, Filippo, Rosa, Giovanna, and Chiara, to invite me. It's a great pleasure to address this audience. Has been working on company and financial regulations for a while. I trained as an economist at the very beginning. I hope you don't mind. But I've been working with lawyers, and my economist colleagues nowadays don't look at me very pleased. But still, I'm here, and I can try to do both, so to combine in a very European way, actually, law and economics. So the idea today, because we have been working on discussing oversight of the digital monies ecosystems, is to me to start and setting the scheme. So I will try to give you at least a flavor of a systemic understanding of money as a system, as an infrastructure. So I will really take analogy with the old-fashioned framework, which was established through time, through history, and was quite well established. There is, the institutions are never perfect, never fully stable, but still the system we were accustomed, which was central on the central bank and the banking system. And this is quite compatible with my understanding of the Financial Stability Board perspective, which call for building the new regulation on the idea that if you do the same business, you should afford or bear the same risk and so be submitted to the same rules. And the main point to begin with, I will step the steps you will understand later. The main point I built upon, just as a starter, is that I don't want to focus on the money proper, on the form, on the physical or digital support that money takes, okay? But more on what money does, which is typical functional perspective, but I try to renew it in this systemic views. So what money does is more from the viewpoint of the actors which are involved and want to use the money system to pass through the money system to do something else, which is not monetary in nature. So the idea that because we are in the verge of, or we want to be on the verge to digitalize everything, money is part of the deal, of the social forces want to introduce this digital environment and to use this new platform, new technology through it. And of course, it has some bright sides, so like innovation and the prospect, belief or expectation on this progress that the new technology can bring to us in terms of efficiency or new purposes, but also some obscure side. And sometimes innovation was also the triggering cause of the systemic crisis we experienced in 2007, and has been discussed as a problem as much as an advantage for the kind of derivative where the innovation much challenged at that time, but also innovation in other regulations. So let me build upon this idea that we don't care about money being either physical or digital, but what money does. And so I will pass through the idea by addressing money as a system, as an infrastructure, as like a platform, and like a building having three floors. So the first floor, I think you will agree with me, at least with this, is that functionally speaking, people ask money to pay. Okay, so this is to me very ground level of the money system as a building to say that monies represent a symbol or a token for purchasing power, which is the capacity of these special things, this money proper to pay for things. So when someone has to perform a payment or transfer this means of payment to someone else, pass through the money system. This is the ground level, okay? And this resonates with the theoretical understanding of money as a unit of account. So like a system of mutual debt and credit, or from a legal viewpoint, a system of mutual obligation, which has to be settled. And of course, this is the sign we are talking about can be material, but is by nature symbolic. So it doesn't mean to have an object. So the money proper can be digital, electronic, can be whatever society or that group of people decide to be. The point is about the symbol, which the token, which embed this purchasing power. So the capacity to transfer this social object, which enable to perform payment. And what Schumpeter say that absent economic development, money look like an accounting system. So you don't even need a market. And I choose this quote by Schumpeter because he was a liberal and Austrian economist. So it was really pro-market at that time. But even him admitted that at the ground level, money doesn't require a market. Because at the ground level, absent development, which for him was really connected to money and credit and the money market, money look like a system, an accounting system shared by the money participant in which they can record their mutual positions, okay, the debts and credit obligations. But at some point, we have to step further. So a very important problem, misunderstanding here, is that we really need to go beyond this market bias, which I call the market bias. Let's say that we don't ask the money system too much, from my perspective, and this is more controversial point. So me having this shared means of payment, this unit of account, it doesn't mean that we can measure value. So we didn't realize a uniform measure of value or an objective standard of value through that system. We just have something which people transact, but the actual value remain in the people's mind and the people choice, let's say, the transaction they perform. And this Pareto, as I call it this, as again, is a very pro-market, very liberal economist, which clearly said, is in French, but I can't translate it, the price is not an incarnation of a concrete manifestation of value. It's not, it doesn't embody value, okay? It's not Buddha, it's not a God which come to the earth and be incarnated, be embodied in something, okay? It's a subjective condition. So value is attributed through the people which perform the transaction according to their will, or they can be forced into them, but it's another story. But still, it's something that doesn't belong to the money proper. And so the second point, which could be more controversial, which is Schumpeterian in nature, is that when money is, this money proper exists and is used, the intermediaries always unequivocally end up doing credit through it, okay? So in a way or another, through the functional equivalence to the issuance of cash equivalent, the intermediaries create credit. And this is why banking, in a way, is really connected to the money management, in a way or another. Of course, the design can address this differently. But cash equivalent are there, we cannot ignore them. So if I have a reserve asset, I can do fractional reserve based upon that reserve asset, or even if I have just banknotes, which are promised to pay, I can still build upon them and create a system. And when you go to an account-based system, it is even easier to create this kind of leveraging upon the money proper. So credit entered the scheme, and these financial institutions which are in charge of payment end up doing also lending or some activities which resemble to credit. So what happened here, and this is the third level, the third floor, I'm going quick, short of time, is that when you introduce credit over the second floor, these intermediaries has to settle position within themselves, among themselves, okay? So you end up having something which is either is a money market or a central bank facility in the current setting. So either they find the ways more through private law arrangement or corporate contractual arrangements, or simply shadow central bank arrangements to do interbank clearing and settlement, or of course they pass through the central bank facility, use the central bank reserve management and other facilities, because they manage on behalf of all the other customers which access the money systems, they have these material positions among themselves. And it's cost efficient and is economized on effort and trust, etc. And also even more profitable because most of them are profit-seeking institutions. So this interbank dimension is very important. Here I refer to Keynes because we cannot forget here when we discuss money that liquidity doesn't exist for the system as a whole. It's always something which stays with them. So can just pass through one to another, but can disappear suddenly if they start passing through. But it doesn't exist. So the system cannot liquidate themselves. So it can disrupt, of course. And so what happened when the liquidity crisis occurred is that the money system collapsed because people start using it or because they move to a competitive alternative system. but they cannot exit the system as a whole, of course. You can have opportunistic behavior at the margin, but you cannot exit the system. So this is the three level I just described. The first floor is the payment level, can be scriptural or asset-based. The second level is credit, and cash equivalent is the point here. So you really do deposit banking or issue banking. And I was surprised that no one was mentioning this as a theory or historical example of cryptocurrency, or because these are quite analog to issue banking, which you have experienced in the past. So it's a closest, at least in some circumstances, under some design. And the interbank level is especially sensitive for us, especially because of the recent financial crisis, which we should not forget. So when I come, and I will conclude quickly, on the Digital Euro Initiative, at this stage, I have more questions than answers for you, but I think quite right questions can be still useful for the thought. So my first problem will be at the private law dimension. When we want to introduce a digital euro, we have to decide how this enters the current landscape, which was featured by market-based finance, which has this tendency to securitization, is based upon securitization. Securitization embeds some leverage. So what I just mentioned, it was market-based leveraging, but it's still leveraging. So it's still increasing in short-term debt and credit positions, which are subject to runs. New kinds of runs. They're not typical bank runs like 19th century, but we saw at which point they can be disruptive. Just 15 years ago. So I think we can still remember. And when we talk about tokenization of assets, this could be a way to put this kind of securitization and money market making on steroids, because it goes even faster, even more secure. In this case, it can be a threat as much as an advantage. So we have to decide what will happen when there's a new kind of cash equivalent issuance through digital means disrupt, because this could occur, and we have experience, very recent experience of that happening. So, and how the public or the private authority will be responsive or preventative about this. And I didn't see this clearly stated and discussed in the digital euro proposal. So I asked myself why. Why we are not taking into account these current conditions. And because the actors, at least some of those actors behind these initiatives, not the digital euro, but the private side of it, can be very interested in renewing that kind of market-based finance through new means. They always do this. We try to regulate them on one side and they step aside and doing something else. Digital means could mean that. We should address this, I think. And the second point is that more public law, typical public law questions, I think, that is, I found this in the review of literature about central banks' operational design. Central banks have at least three dimensions. They are banks of bank, they are treasury banks, so public sector banks or agency for the public treasuries and the public finance management. And they are foreign exchange agency or banks for the world system, because they are still guarantor of the convertibility with foreign currencies. And the digital euro intertwine with all these dimensions, and I don't see the clear answer about them, and we start asking this question in this meeting, and I'm very glad with, because these are answers which has to be asked. So is the European Central Bank ready to admit all the issuer of digital payments and digital currency or manager of the digital euro on his behalf access as facilities? Are they all becoming member financial institution of the European Central Bank along with the member state or not? I don't have the answer, but I want the question to be asked. And someone say, what about the peculiarity of the European Central Bank setting? Because the member central banks are no longer independent. They are no longer central bank in some respect, because they cannot issue money at will. And they will be constrained to do what when the digital euro is entering into the scheme? How is the internal relationship managed? because this also relates to the management of the public debt, which has been not yet solved from the institutional viewpoint. So ask the Greece what happened when you have trouble at that level and the central bank is not immediately ready to respond. And even when it's ready to respond, you have hyperinflation and distrust in the money can occur, but still, central bank are usually lender of last resort. They have some institutional capacity to prevent the worst, at least up to a certain point. And this has to be asked, I think, when you introduce the digital euro, especially in the European setting, which is still unsettled from this public law viewpoint. And when the foreign use is there and cross-border payment are there, again, the digital euro proposal has to address this because, for instance, the Chinese proposal is definitely, the People's Bank of China has been really clear in its willingness. Let's alone if they will succeed, but they are very clear in the policy objective, the geopolitical strategy to use the digital one proposal to facilitate and improve on their global, I don't know, but definitely cross-border and commercial trade relationship with friendly partners. So these three dimensions has to be addressed. I cannot see them in the paperwork that has been submitted so far. And I don't think we can go ahead without asking those proper questions. So just concluding remark, I stop. I think that we are confronted with the key novelty. I really agree with all of you that deserve to be discussed. But I think we should not neglect the importance of the digital monetary platform as information system, as ways. I think Geoff was very clear in saying that we can use them also, not just because we issue speculative assets through them, because we replicate the account-based system. We can use them also because they are information system, they have accounting system. And we have problem with the speculative dimension. We had already experienced with even quite material actors which are recently failed. And we should always remember that the law makes money. It's not the reverse is not true. Law has always been there. Even if it's a private initiative, the notaries were there. When we start issuing international money, it was a completely private affair. But the notaries were there to certify the proof or the promise to pay and the letter of credit, and the very original money and credit at the international level was private, but was still legal in some meaningful full for the actors. And what happened with the derivative, which I mentioned at the beginning, was that before that unfortunate act of the US administration of that time was enforced, the derivative was a very marginal asset for professional use, and as go into a very enormous big bang very fast. And it was one of the triggering elements of the systemic crisis which just occurred. So I worry that if we can do the same with allowing either the stable coin or the digital euro without asking the proper questions. So thank you very much. Just few articles if you want to read more, and willing to discuss. Thank you very much.
Thank you.
Thanks a lot, Yuri, for developing this theoretical analysis of digital monies and their oversight. And I'm immediately turning over to Andreas, who will look into the digital euro more specifically, innovation, and in particular the business model that there might be for the digital euro.
Yes, I will. Thank you very much to the organizers for the invitation. Yesterday and today also I learned much. I learned also much about different perspectives which were needed to discuss here. If I was seeing the topic of our panel, balancing innovation and oversight, regulatory approaches to digital legal tender, I was thinking, okay, what can I'm economist, from economic perspective contribute to this? And first, let's say, cognition of this was, or association was, that it's a story of tension. And so far, my contribution will take some reflections on the digital euro and the innovation, and under the, let's say, focus of relationship of tensions. The digital euro as a European central bank digital currency cannot really treated separately by the position of the European Central Bank. About this, this issue was yesterday and today were some comments and some contributions made. I remind on the fact that the ECB fulfilled its task in monetary policy, in payments and financial stability, and in banking supervision, and based on main regulations, which you maybe majority is has a legal, let's say, background based on EU treaty, ECB status, and SSM regulation, which you know maybe better than I. If you look from economic perspectives with respect to money, today we have the situation that central bank money we face in two forms, in form of sight deposits at the central bank of mostly financial institutions, and second in cash for non-banks. Both come with central bank balance sheet extension. This is our today's situation, and the question is what will be the future if we, if this question was also raised in the previous panels, when the digital euro will come. About the time I will do, I will not make any remarks. In one paper I mentioned not before 2030, but now I think after this discussions here it will be much longer. And then we will have these both forms. This means sight deposits of commercial banks or financial institutions at the central bank and cash, plus the digital euro. From economic perspective, the question arises, of course, what brings then this additional central bank money? Yeah? This is from my side the question about the business model behind this. Yeah? And of course, then based on this business model, then the resulting design of the digital euro. If we look on, let's say, from economic perspectives on this question, then of course it's necessary to define, and this issue was from several perspectives also raised in this previous panels, the question of the definition of the digital euro, this discussion of money versus currencies, money as, let's say, money in use, which we define in economic perspective via these monetary functions, medium of exchange, medium of account, store of value, for the digital euro with this, with this limitation, versus currency, which is understood from the economic perspective rather as a state-backed money. And this versus this discussion, legal tender functions, and to translate this in the digital sphere, I've learned now that it must not be, it's not a necessary condition. This legal tender function, it's a legal term. Yes, normally we from economic perspective we don't deal with this, but of course this has implications. Of course, because you are then you have the necessity to contract with this. From economic perspective, to define this digital euro, or what could it be? There is to look on this business model. There is a necessity to define for this future form of central bank money what we call relevant market. The relevant market is this market where different products or services are competing with each other as near substitutes. Yes, this is then with this you can then define then the relevant market, and from this, let's say, definition of the relevant market raises then the questions, yeah, what is the competition environment for the digital euro? This is also this issue was raised yesterday and today. I see here different, and some of the colleagues here which had the position of previous speakers. This could be CBDCs of other large currency areas, especially in the past with respect to the US dollar or now with the Chinese renminbi. This could be stable coins of big tech giants. This is also related to the history of the mentioned DM project, for instance, or if you took a broader view, a competition between different economic systems. This can be also a potential a competition line for the digital euro. For instance, market economies versus state capitalism. The digital yuan, digital renminbi can be also an instrument of competition of systems what we can face in the future. Or, and this is for me the most interesting topic, I think, and for many of you maybe also, the competition with private payment instruments of financial industry. Okay, I will not dig now into this areas directly because this is a long discussion. Basic questions for our topics is now what comes with the digital euro and what is the innovative position, coming to innovation. Innovation, there are many definitions in the literature and theory discussions. I bring some, let's say, from current perspective now here. And synoptic view, innovation as a multi-stage process whereby organization transform ideas into new, improved products, services or processes in order to advance, compete, or differentiate themselves successfully, hopefully, in their marketplace. What is important, it must be new or improved, or it should be brought into the market. In other cases, it's not it should be successfully brought into market. The question of failed innovations was raised in previous panels. From this, let's say, definition of innovation raises in our context with the digital euro arise, let's say, two different perspectives. One would be, from my perspective, if I see on this issue, the digital euro seen or recognized as innovation. We have some hints for such recognitions. The ECB argues for the digital euro as the first pan-European means of payment with application scope, now covering nearly all payment situations that requires a CBDC status as legal tender. This was from citation of Burkhard Balz in 2023. Yes, it can be, but this can be a recognition of this innovation status. But the question arises: is it really new? What is the novelty, and what is the innovation in this? The second perspective of analysis can be or can focus on the other aspects, and this was also yesterday in the keynote very intensively addressed. Innovation induced by the digital euro. This is the second perspective, which maybe from some perspective is more leading to address the aspects here in practice. This means the digital euro as a basis for innovation by financial and, I must underline, non-financial industry and the related ecosystems. This means open finance, for instance, but also Industry 4.0, if you look on this in a little bit a broader sense. Innovation, Innovation seen from the economic perspective, and this problem is very, let's say, intensively tackled by the scientific fields of economic policy and industrial economics, requires competition. This was also mentioned yesterday very often. Competition on markets for financial services, And insofar, one of the, let's say, necessities from economic policy should be that it should foster, of course, competition with high priority, which sometimes is colliding with political ambitions. Okay, to cut a little bit this topic on the side. Important topics concerned with respect to these issues, which we can discuss later also, are effects of this innovation brought maybe by the digital euro on financial industry and ecosystems versus the development of fintech sector. Yeah, this is I think there are different opinions about this. Second, the effects in a broader sense, I thought that I recognized this in a previous contribution of one speaker yesterday, the effects on the Industry 4.0. Yeah. This means not directly only the concentration on the financial industry, but also is it really suitable to foster to be compatible to Industry 4.0 requirements for the future. And this third issue, the third topic related to this is, last but not least, the private end user. Yeah, this is the question: what is the innovative position against the perspective of the private end users? What comes with this? I come to the end. If we are clear about this, and I have a little bit of impression that it's still not clear, or not absolutely clear, let's say, or is in discussion, there should be, based on these considerations, a decision about design of the business model. That's the first. Yeah. And my opinion, there is still some uncertainties about this, and the related design of the digital euro. And from this then derived then these issues which actually are discussed, implications for provided services, technical properties, finally, required infrastructure, applied regulations framework, and supervision. Thank you.
Yeah, thank you very much, Andreas. You raised a number of interesting questions that we will hopefully be able to come back to in the discussion. Is the digital euro innovative itself? Does it induce innovation? Yeah, I leave that open for now. And I pass the word over to Reyes, who will be speaking on the interplay of markets in crypto assets, regulation, the Payment Services Directive, and the digital euro. So she's making the connection between the private players and the central bank. Thank you.
So, thank you. Thank you very much. Thank you very much. Good afternoon to everybody. First of all, I would like to express my gratitude to the University of Florence and the European Banking Institute for hosting this important event. And a special thanks to Filippo Zatti and Rosa Giovanna Baresi. I'm truly honored to be a speaker in this international Congress. Finally, all together are here in Florence 6 years after. So thank you very, very, very much. Well, after yesterday till today, listen all the contributions of the speakers. I'd like to do an introductory remark. And my introductory remark is the importance, the utmost importance of the cash payments in Europe. And why I say this in this Congress that is about digital legal tender. I say this, the importance of the cash payments in euros, because of the massive blackout we had in Spain last Monday, 28th of April, in Spain and in Portugal. The blackout paralyzed the Iberian Peninsula for most of the day, 10 hours, 11 hours, disrupting millions of lives and 5 deaths. I'm sure it's the biggest blackout in Europe, with more than 60 million of citizens involved. Many people, especially young people, find themselves unable to buy food or just a bottle of water because they didn't have cash. They use Apple Pay, Google Pay, Bizum in Spain, instant payments, but no cash. You couldn't buy a bus ticket to go home. The train was closed. I mean, the life paralyzed during 10 hours. Maybe, I'm not very sure, but maybe this is one of the reasons that the Payment Service Directive, the third, the amendment of the PSD2, improve the availability of cash in shops, for instance, and via ATMs, by allowing retailers, merchants, to provide cash to people without requiring a purchase, a transaction, buy something in the shop. And from a legal point of view, this is the most important, without necessity to obtain a payment service provider authorization. I mean, it's curious, digital euro improving cash supply at the same time. Also, the Spanish blackout and the Portuguese blackout, 28th April, has been very important to check the impact of the blackout in our financial systems. The impact of the new regulation, the DORA, the Digital Operational Resilience Regulation, in the financial system of Spain and Portugal. The system collapsed. I mean, there were no digital payments. The banks couldn't support the bank services. But we haven't had a cyber attack. And when the light came back, the system worked well. There was an interruption, but the system didn't fall. I mean, we could and reinicializar, we could restart, thank you, the system. The Spanish Stock Exchange didn't paralyze, didn't froze, but the trading volume fall 25%, I think. But the Spanish Stock Exchange has passed the DORA test, not our banking system. I think it's something that we should think about that. Well, many things in my brief presentation has been said. I mean, yesterday, Sebastian Omlor, Di Setze, Rolf Weber, Christian, Yuri, Seraina, of course, with retail payments, brilliant, congratulations. And I mean, many things has been said, so I'm not going to repeat, but this morning, final colloquial debate, you were talking about the CDBC, stable coins, and in USA, I think yesterday someone said that President Trump executive order from January said any ongoing plans at any agency related to the creation of a CDBC within the jurisdiction of the United States shall be immediately terminated. Why, in my opinion? Because there's no reason of a digital dollar. Why? Because 90%, if you read the last city report, 90% of the stable coins are denominated to dollar, are pegged to dollar. So I don't need to issue a digital dollar. Well, digital euro legal tender as means of payment. We were talking in lunch with Luz and Miguel Ángel Fernández Ordóñez, former governor of the Bank of Spain, that legal tender is a legal concept. And where is in Article 10 and 5 of a Council regulation of 1998. That said, this article says that banknotes and coins are the legal tender, in the European Union. So we need another law, another regulation that says that digital euro is a legal tender. Without a legal back, we can't say that digital euro will be a legal tender. Is a means of payment? Yes. Zati and Baresi has an excellent paper on the difference between means of payment and medium of change. So we need a legal recognition. So I think that the subject is the payment system. I mean, that's the key, that's the clue, the payment system. And Payment Service Directive and the new Payment Service Directive will be applicable to the digital euro, yes. Expressly, Article 5 of the proposal regulation says that it's going to be directly applicable. So payment service providers should enable users of digital euro to access and use it, open accounts, bank accounts, or not bank accounts, funding and funding operation, and so on. And the proposal of the digital euro makes reference to the basic digital euro payment services. This is the minimum. Opening, holding, and closing a digital euro payment account, of course. Funding and funding from a non-digital euro payment account. Transactions. By means of an electronic payment, and so on. Is the digital euro a crypto asset? No, not at all. It's a digital form of a single currency, of a legal tender. But it's not a crypto asset. Why? Because crypto assets means DLT, distributed ledger technology, and digital euro is the digital form of a currency. But can be a crypto asset? Yes. Can you tokenize the legal tender? Yes. And so, in theory, MiCA, Markets in Crypto Assets, because it's a crypto asset, will apply. No, expressly, yesterday I think someone said that, expressly doesn't apply Article 2, of the MiCA regulation to the digital euro by decision of the legislator, not by nature, because tokenizing digital euro is a token, it's a crypto asset. Stablecoin is a cryptocurrency, yes. Stablecoin refer to euro. Are electronic money tokens? Yes. And asset reference tokens? Maybe, it depends on which case. For me, the main difference is the law. I mean, stable coins are not legal tender, but are means of payment, of course. And so, the Payment Service Directive applies. In United States, they speak about covered stable coins. That in Europe is the electronic money token. It's one by one. I mean, one stable coin, $1. When in Spain and in Europe, we said one tokenized something, crypto asset, and €1. Which is the difference? That the stable coins can fluctuate if they are traded in a marketplace, and the digital euro, no. I think it has been said several times in this Congress, the digital euro, no risk, no liquidity risk, no credit risk, no market risk. And so, my opinion, there could be electronic money tokens. And electronic money token, MiCA says they are a crypto asset that purpose to maintain a stable value by referring the value of an official currency. So electronic money tokens are crypto assets and funds. And that's the confluence between electronic money tokens and funds, MiCA and PSD directive. And the problem is that the PSD1 couldn't imagine the crypto assets world. The PH2, yes, but not the one. And so there's one corpus, a legal corpus, and another legal corpus that is the electronic money directive. But there's a man, as Yuri said, difference between public money, digital euro, and private money. Depends on cryptos or not cryptos or MET or stable coins. And for me, the main difference is that the users of digital euro are not supervised with custodes, ipso custodes, who watch the watchmen. With digital euro, nobody. With electronic money tokens, stable coins, of course, the European Banking Authority, national authorities, because it's MiCA regulation. And for me, the supervision is also is a very, very important thing. Well, I don't want to speak, I'm just finishing, but what is the problem now? That some crypto asset service providers, the CASP under MiCA, if they provide the service of account servicing payment, they have to meet two regulations, MiCA and PS2. No, that has no sense. And so in PS3, they are going to merge a single regulation for this gray area, this border between crypto assets world and and payment services. And I think, well, this is my last slide. It's very interesting because the definition of tokenized or crypto financial instrument, and when MiCA applies and when MiCA doesn't, is really complicated. And so in guidelines of the European supervisory authorities on crypto assets, the last page is a flow chart that they are asking, is the token a digital representation of a value of a right? Yes. Can be transferred electronically? Yes. What is the technology? Yes. If you go, yes, 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 no, okay, no MiCA. Yes, 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 but it's a bank deposit, another regulation. Yes, 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 but it's an insurance crypto asset, Solvency II. Yes, 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 but it's a financial instrument, MiFID II. So they are like in a football match, goals outside. So thank you very much, and that's my main ideas. Thank you.
Thank you very much, Reyes, especially for reminding us of the importance of cash as a fallback option, right? There is also risk attached to digitalization. We are vulnerable to cyber attacks, and we are vulnerable to outages of the system. And I think there are several member states in the EU that are particularly keen, right, to maintain cash as a very important complement to potential digital euro and other forms of payments. I am turning to Christos Hadjiemmanuil, who will finish off this session with his insights on the regulatory and policy objectives that we should address at the European level in order to establish an ecosystem for the euro. Thank you, Christos.
Well, I don't think that I'll make many friends with what I have to say, because various people here will feel a bit offended by my remarks, but I'll try to introduce some necessary conceptual clarity on these monetary issues, which are always a big problem in terms of the vocabulary used, etc. Let me remind you that just a few years ago, back in 2017, the BIS published a report on the rising crypto market, and there the authors had inserted their views on money. They had something called the money flower, a new taxonomy of money, a nice little daisy, basically, with intersecting leaves, classifying money in terms of the issuers, the technologies, the forms. And then this same chart was republished in the Bank of England Quarterly Bulletin by the ECB. You see it continuously. It has become a point of reference for some, at least for the professional central bankers. And I've always thought, not a stupid idea, but how misleading this type of conversation is. And we had the same type of conversation, the misleading type, here today. And we had it a few days before in Zurich at another conference at the Point Zero Forum, which is a major event on blockchain and the rest. You know, money is not about the technical form. And the new concept of money cannot be based on whether it is blockchain-based or account-based. And it's not me saying that. It is somebody slightly more well-known or notorious than I am. John Maynard Keynes wrote a book almost a century ago. It is one of his two major books, not the general theory, the other. It is called The Treatise on Money. Let me please read. I've checked it just now because of what was being said here. Let me read you the very, very first sentence of the book and then one more. Money of account, namely that in which debts and prices and general purchasing power are expressed, is the primary concept of a theory of money. And he distinguishes that, money of account, from the money stuff, from money proper, the things that we use in order to make payments. And then one paragraph further down, he says, money itself, namely that by delivery of which debt contracts and price contracts are discharged, and in the shape of which a store of general purchasing power is held. Essentially, he talks about means of payment and store of value, derives its character from its relationship to the money of account, since the debts and prices must first have been expressed in terms of the latter. I find this eminently coherent and reasonable. The basic notion of money before money existed, before coins were coined, was notation. accounts for you. People were writing sums that they had received, that they owed. Well, 1700 years before somebody in Lydia or in the Near East discovered monetary tokens. Correct. And they were writing accounts and they were entering into contracts. So you could say that the critical thing about a monetary system, insofar as I am concerned, is denomination, the unit of account. So here today, we have spoken endlessly about the new forms of money, how they compete, etc. But these are asymmetrical things. I asked Mr. Goodell, who is very charitable and sees Europe acquiring a digital euro in 15 years' time, whether the thing that he has in his pocket, in his possession, and shows us as money is anything other than a claim on a central bank, a liability of a central bank. There is another eminent theory of money, according to which money derives its moneyness, and now I'm not talking about the unit of account, I'm talking about money, the stuff, derives its moneyness from the fact that it is accepted in payment by the tax authorities or by the state. This is part of the state theory of money, one little aspect that Christos mentioned earlier today, but it is critical. I don't claim that this is it. I simply state the fact that acceptance in official transactions is a critical aspect of money. So let me tell you how I see the current situation, not from the usual perspective, technology and private law, but from a public law perspective and from the perspective of monetary sovereignty, public law, not in the sense of rules that somehow guarantee and enforce the interests of private parties, but public law in the sense of law that promotes the strategic interests of a polity, of a state or of a family of states like the European Union. So let me tell you, I was asked to talk about regulation in digital money, and regulation for me is not your typical stuff that we talk endlessly about in legal conferences between monetary lawyers and financial lawyers, but law and regulation from a different perspective, the perspective of the preservation of fundamental interests and strategic objectives of a polity, whether this be Switzerland or the UK or Europe in the sense of the European Union, a family of nations with a single currency, namely the euro area. So the critical question from this perspective appears quite differently. I know that in the European Union Treaty again and again 7 times, not once, 7 times, the drafters of the Maastricht Treaty inserted this famous clause that this economy, make no mistake, is an open market economy with free competition. It says so not once, 7 times in the text, including twice in the monetary provisions. Why? Because at the time when the euro was created, all the rage was, remember, this was just after the collapse of communism, when everybody thought that liberalism was the name of the game and that globalization would proceed without impediments. At that time, everybody agreed that now that the communists are out, private economy is in. But nowadays we are finding ourselves in a fragmented world, and as I see it, there are 2 tensions that a legislator in a major jurisdiction, be it the UK or the European Union, has to take into consideration. And this poises the interests of an organized major polity against 2 types of challenges, 2, not 1. The one is the dominance of American companies, namely the big tech, the 7 companies, which essentially hold an almost monopolistic power over the provision of certain services, and to the extent that they manage not to sell, that would not to provide these services as a stack in a packaged way together with other services, their advantage becomes unassailable because they combine a seamless ecosystem for payments with essential digital services that everybody wants to use in the current context, which means that you have effectively a double leveraging of what? Of network economies. Money, many a speaker today said so, is a system and a network. The monetary system is a network. It derives its power by the fact that it connects everybody. It connects everybody by reference to a single unit of account. Its systematicity is derived from the network and the unit which defines it, and the unit defines, so to speak, I'm using here an expression used by French theorists, acceptable, monetary space. The monetary space is defined by the network operating under the denomination, and two monetary spaces meet where you have exchange transactions, where one currency is turned into another. So one problem that Europe faces today as an economy, not as a monetary system, is that payments in Europe critically rely on two, and in the future, three types of non-European, non-Swiss, non-English service providers, namely credit card companies, which still carry on 5 trillion of transactions per annum, two companies, getting good money, holding, how should I put it, merchants from the throat, extracting value, which in a modern environment should not be there. There should be some sort of diminution of the profits accruing to credit card providers, especially since this is money that flows out of Europe towards the other side of the Atlantic. So this is one reason for which you need a seamless, non-card-based payment system in Europe, in the UK, in Switzerland. The second group of intermediaries are the big tech, which effectively package together products in a manner, and it is not me who's saying that, American court said so just 1 week ago, is anti-competitive. They are asked, not by me, by the American authorities to break down these silos that they have created, which, if you add to them the monetary aspect, this is why I asked you whether you are using them, would make them tremendously monopolistic. Why? Because of what we call natural monopolies. When you have unlimited economies of scale and network economies, of course, the situation is one of natural monopoly, and regulation is asked for in order to break that down. The third possibility is stable coins. Nowadays, today, two bills are discussed by the American Congress. The Stable Act, as it will become, and the Genius Act, as it will become. A stable genius. Wink, wink. Does that ring a bell? Who is a stable genius? So the stable and the genius are essentially the American license to big tech companies close to the current administration to print money at the expense of official dollar money, stable coins I'm referring to, correct? This is a law legitimizing, regularizing, fully recognizing stable coins as a form of money for the United States, as an alternative to the official dollar. Well, that's an American problem. Let me not take a position. Some people will make very good money, and this will provide an alternative to the official use of money, or account-based interbank payments in the United States, or in the famous American check, which still survives 25 years after it has been abandoned by most European countries. Okay, but what about us Europeans? Stablecoins are a threat not because they are issued by big tech, but because they threaten Europe as well as the United States with the demonetization of official money and its replacement by a monetary system that will be totally based on inside money in the technical economic sense, namely money issued by the financial or whatever private system, and not relying upon an external anchor, whether be it a metallic currency, or an official currency, fiat. Okay. Would you like to live in a world without outside money, only with inside money? How do you conduct monetary policy in such an environment? Irving Fisher, decades ago, had probed this question, but the answers are not quite clear. And then again, would you like to be in the situation where the dominant form of payment takes the place of near-field communication payments based on an app which on its turn translates into credits or debits on a blockchain denominated in a stable currency which is itself denominated in dollars, meaning that even though the pass-through, all the intermediary steps take place in non-dollar denominations, the end-to-end situation turns dollar claims into dollar claims, without banking, without reserves, without anything. Is this economically reasonable, or is it to effectively surrender society to the holders of this choke point? And is this European or English or Swiss autonomy, strategic optionality? We are talking about autonomy as if we want to push people out. No, we want to keep the optionality. As things currently stand, in wholesale payments, the dollar is not simply king, the dollar is a tyrant. Why? Because the American dollar can be leveraged as a tool of foreign policy through two major choke points. The one is SWIFT, the other is secondary sanctions. Add to that a full dollarization of the economy in the hands of companies that will enforce immediately the secondary sanctions, and then you understand that you have surrendered all your financial capacity through these stable coins to the American government. And I have nothing against the American government. In fact, I'm a great friend of the United States and believer in the transatlantic alliance. But it's one thing being an ally and a different thing being a vassal, or a serf, or worse. As I see it, and let me conclude with that, you ask again and again, Seraina, and I don't think that this is an innocent question. Do we need a legal tender? Do we need a legal tender? Not a legal tender, a euro, digital euro legal tender. No, we don't. We don't need a digital euro legal tender. It does not have to be legal tender. This is a canard. The true question is, do we need a seamless, effective, cheap, efficient, pan-European payment network that links one end of Europe to the other instantaneously in euro payments, whether the end-to-end is account to account, or the end-to-end is wallet to wallet, or the end-to-end is wallet containing digital euros, legal tender digital euros, to digital euros. And to conclude, Europe has taken steps in 3 directions, and I hope that the third will soon become the law and will become effective. We should not think about this wretched piece of legislation that is languishing through the European Parliament and the Council, namely the Digital Euro Regulation, the draft Digital Euro Regulation of June 2023. This will eventually become law, but this is not it. This is not it by itself, because what it does is that it creates a mandatory acceptance. Why mandatory? This I don't understand. Christos Gorgios said that legal tender means obligatory acceptance. Yes, it means obligatory acceptance in private transactions only in the sense that if I hand over a legal tender and you don't accept it, I have a good defense. Or possibly, depending on the jurisdiction, that your claim is discharged. You do not have any longer a good claim. But what Christos also implied, and what the regulation does, is that it does not only give legal tender to the euro and to the digital euro too, it gives cour forcée. And cour forcée is something different. It is a Napoleonian notion whereby if you don't accept the law, you are subject to sanctions. That's different. So, yes, I don't think that we need a digital euro or a euro legal tender. But what we need is a seamless network for payments. And this is promoted not only by the digital euro, but by 2 other things. By MiCAR, that, as we have just heard, effectively creates a pretty tight regulatory environments for stable coins and discourages opportunistic stable coins. Remember, the reason for which Meta did not manage to launch Libra either in Europe or anywhere else was precisely because of the announcement that the European Union would adopt MiCAR. So it already had a global effect. And it certainly protects Europeans today. To give you just one example, it came into effect, full effect, 31st of December 2024. Since then, you have seen the delisting from, what do you call them, blockchain exchanges. So, what are they called? Exchanges. The delisting of the Tether euro coin, USD, I don't remember how exactly it's called, and another 3 or 4 stable coins. Why? Because they cannot comply. Why they cannot comply? They don't have reserves. This claim to be backed up by reserves, currencies, but they don't have the reserves, so they delist. The third thing, and I conclude with that, is the following. Just a few days ago, not a few days ago, 9th of January, another regulation came into effect. It will come into full effect in October, but is already in effect. And this is called the Instant Payments Regulation. It is all technology. It is not about the blockchain, it's not about digital euros, but that's for the first time ever the obvious. It forces banks and other payment system providers to process instant payments end-to-end within seconds by charging the originator's account and crediting the recipient's account. For the time being, only the reception is mandatory. In October, both sides will be mandatory for payment system providers. And the beautiful thing, at a cost which is no more than the cost for SEPA payments. As you all know, SEPA payments are dirt cheap, which means that if I can pay through my near-field communication device, my telephone, not by using your MasterCard, but by using my instant payment system, suddenly you have achieved a very significant step towards the integration of European payment systems. And this is essentially some sort of public-private alliance of Europeans for Europeans. And I'm talking here to an Italian audience, and you probably know that Pagopa, what do you call it? Pagopa is an effective system. But you know, when I wanted to pay my son's fees My son is a student in an Italian university through Pagopa. Well, I couldn't do it because it is not linked with a Greek system. But the moment that instant payments will be standardized and unified, that is from October onwards, a major step towards regaining strategic autonomy in this field will have been gained. Thank you so much.
Thank you very much, Christos. As expected, it was a very dense presentation, and I don't even attempt to draw any conclusions or to summarize it in any ways. I just take from it, and I very much agree with you, that at the core of the objectives that we are pursuing in Europe, and I'm glad that you count Switzerland to the broader European family, which is not a given in the current fragmented world, right? You know, that our core objectives should be to preserve our strategic interests, and obviously the monetary system is very much at the core of these interests. So I think that is a very nice way of concluding this panel, because we've actually reached the time, and I got very strict instructions from the organization that I should end the panel on time. I thank all the panelists for their insightful contributions, and I look forward to the continuation of the discussion. Thanks a lot.